Hi everyone, this is Tax Cuts and Jobs Act mini series number 2. I'm Andrea Karle, and then in this series we're going to talk about basically Schedule A, the child tax credit, and we're going to talk about some other important updates. As always, just note that this is just a very broad overview of everything and that it's just for informational purposes only. If you have anything specific, you should seek out either your counsel or your CPA. So in this first part, we're going to talk about the changes to Schedule A, the itemized deductions. And I want to just remind everyone that we talked about in the first mini-series that the standard deduction is now higher, and that's for the tax years essentially after December 31st, 2017 to January 1st, 2026. So essentially 2018 to 2025. And you'll notice that for individuals, it's $12,000. And for married filing joint is $24,000. And I'll remind everyone that's essentially double. It's not quite double, but it's essentially double. Also note that this little I here stands for individual and MFJ stands for married filing joint. If you see that throughout the slideshow, that's what that means. You can still itemize deductions on Schedule A, but many of the deductions were eliminated or they were limited. So either eliminated or limited. As a result, many more Americans will utilize that standard deduction. One, because the standard deduction is now higher, so there's a new higher bar that you must take in order to itemize. And two, because of the limitations, it's harder to reach that bar. Because on your tax return, you either itemize or you get a deduction, you'll take whichever is higher. So in this case, it's most likely going to be for many Americans now, they will no longer be itemizing, even if you own a home. While many Americans will now take the standard deduction, there are still some that may take the Schedule A or itemize their deductions. So I'm still going to go ahead and talk about the changes. This might also help individuals understand why they will be taking the standard deduction with all the changes on the itemized deduction form. This is what the form looks like essentially now. And so I don't have the form for 2018 tax filing season is not available yet. So we don't have that form, but you'll essentially you'll be seeing big changes on that form when it comes around. So some of the big changes that are on the itemized deduction include the medical deduction, the state and local tax deduction, and the mortgage interest rate. So for the medical deduction, please note that this is only effective for 2 years. As I said, this was one of the items that was retroactive that goes back to your 2017 tax return, which means this filing season. It's only effective for 2 years. So it's after December 31st, 2016 and before January 1st, 2019. So essentially the years 2017 and 2018. The big change is that now everyone's limit is reduced from 10% to the 7.5%, which before it was for only people who were age 65 and older. So this is great news for everyone, but it's really only for people who have high medical expenses and who it's only effective for 2 years, unless Congress decides to extend that. For the state and local taxes, this was a huge contentious issue between the House and the Senate. Especially between states who are in high tax states like New York, California, Illinois, where they might have both high income taxes and property taxes. This was the big area that a lot of people were talking about. This was a hot ticket item. Now they ended up at that it's capped at 10,000. So regardless of what your property taxes and your income tax for your state was, you can only take 10,000. You can take a combination of up to 10,000, but it's limited to 10,000. This is the area that usually pushed people to itemize, but now because of the cap, it would be very difficult for people to itemize, especially if you're married filing joint when the standard deduction is 24,000, because you would have to essentially make up over 14,000 in everything else in the form, such as charitable deductions or your medical expenses. The next thing that was changed is the mortgage interest rate. This one's a little quirky, so just note that that could affect your tax filings. Essentially, the mortgage interest deductible lowered from 1 million to 750,000 for only acquisition indebtedness. However, there's a few caveats to it, such as existing acquisition indebtedness was grandfathered in, and there's a few other caveats to this. So there's a little bit of caveat to the mortgage interest deductible. Another thing that was changed, which were home equity line of credits, which is what this stands for, HELOCs. You'll hear that term before. That's home equity line of credits. And that interest is not deductible, and it used to be $100,000, and for right now it's suspended. Hey, so I just want to remind everyone we just talked about 3 big ticket items. We talked about the medical expenses. That's pretty much only applicable for 2017 and 2018, how that was reduced from 10% for everyone except for to 7.5% limitation, which means that you can take more of your medical expenses. But before, that was only allowed for people who are over the age of 65. And then we talked about your state and local taxes, and how now it's capped at 10,000 for both income and your property taxes, and that's going to impact high income and high property tax, or high local taxes in general areas such as California, New York, Illinois, any other high taxing state. Then we talked about your mortgage interest deduction, which now the limit was $1 million and now it's lowered to 750, but now there's a few caveats to that. So just to note that it could be impacted, but it might not be. And then next we're going to talk about gifts to charity and the changes in that. And I'm going to talk about the miscellaneous itemized deductions. Things that like you normally would take here would be something that you would not get reimbursed from your employer, but is job related. And then finally, I'm going to talk about how the limitations of itemized deductions has gone away. Hi, so the next thing we're talking about is charitable contributions and how that changed. There was a little bit of discussion about how they were going to potentially get rid of charitable contributions as a deduction, and I think they got a pretty big backlash for that. So then they did keep it, and they actually made it easier to get a charitable contribution deduction. So charitable contributions for individual taxpayers are usually limited to the contribution base, and deductions for cash are generally higher than non-cash contributions. That's just general rules. And now under the Act, the contribution base, which used to be 50%, is now increased to 60% for cash gifts to certain public charities. So essentially you can give a little more, and you can get a more deduction if you give more. Again, this will not really impact most people. It'll just be if you really gave away a lot of your wealth in one year. So just to let everyone know, we just talked about that right here, gifts to charities. Hi, so this is the next section after charitable deductions that I'm going to talk about is the miscellaneous itemized deductions. And under current law, this is usually individuals can claim itemized deductions for certain items that exceed 2% of their AGI or their adjusted gross income. That's essentially what that means. And you can take a look at this if you want to dive really deep into it in publication. I would recommend publication 529 if you're like very inclined. However, you may not want to look at that too much longer except for past this filing season, because under this act, those deductions are now eliminated. So anything for items that are like unreimbursed employee expenses, those will now no longer be allowed to take in as a miscellaneous itemized deduction. So for a note for employers is that, you might start getting some complaints from employees saying, hey, I can't deduct this, so it gets harder for them, so they'll have to take the full expense of it. So that's just something to be aware of. Hi, this probably won't impact most people. You first would have to itemize, and then you'd have to make over a certain amount of money, but there is a repeal of the piece limitations on itemized deductions under the Act. So that's for certain taxpayers. Itemized deductions used to be limited for certain taxpayers who made, for individuals it was the 2615, and then for married filing joint it was the 313,800. now that's the limitation is suspended currently under the Act. Yay, so now we're going to talk about the child tax credit. So this comes after you have your taxable income. So before we talked about, in miniseries 1, we talked about taking the standard deduction and then exemptions. So now we only pretty much take a standard deduction or we itemize, and then you have your taxable income. Then comes the tax credits. So this will help out that family of 5 we talked about in miniseries 1 with the 3 dependent minor children that qualify for the tax credit. Before, they were able to claim a current amount is $1,000 for each child, and then this 1,000 is reduced for individuals and heads of households for people who make over 75,000, and for married filing joint, it's over 110,000. It is currently refundable based on a calculation. The due child tax credit will be for again the same, basically the qualifying child. The child tax credit is increased to 2,000. So that's almost doubled, and the refundable portion was also increased to 1,400. So that's great. That's a bit higher, and it will help out the people who maybe you would have had a lot of exemptions before because of many minor children that they have. It also noticed that you can make more and not be phased out. Now individuals can make up to 200,000, and married filing joint can make 400,000. One also note to make about this is that for immigrants, currently you can file a child tax credit if you have an I-10 for your child. That is going away. You're going to need a social security number going forward. Some other things to note is that we now have the dependent credit. This is an additional credit for dependents that are not children. So let's say you have an elderly person living with you that is your dependent. You can now get a non-refundable $500 credit towards your taxes. One thing to note with this as well is I believe that you can still file this with an I-10 and you do not need a social security number. So if you have a parent immigrant who has an I-10, you can still receive the additional credit for dependents, and it's not the same rules that would apply for the additional child tax credit. Just wanted to touch base on another important item that people were confused about was the insurance mandate penalty. This goes away as of after December 31st, 2018. So essentially 2019, you will no longer have the insurance penalty for not having insurance. However, it still applies for the 2018 year. So that is something to note that people don't realize, because everything else was going into effect essentially 2018. This is one thing that does not. So you could still be hit with an insurance penalty for 2018. So that's just that. As always, this is just for informational purposes only. And if you have any questions, we just really just touched on really broad topics, a very high level. So if you have any questions, seek out your tax counsel or your CPA to file your taxes. If you like what you've seen, stick around for mini series number 3, where we're going to dive into section 199A, which is going to talk about the pass-through entities and maybe a little bit of entity choice selection if you're curious about that. And if you like this, please subscribe to my my YouTube channel. Also, if you want, you can share this with your friends. Thank you.